Today, we're going to be talking about real estate. If you have a real estate portfolio, things that you can take advantage of. So let's jump in. There's a number of different types of real estate that people can invest in, but we're really going to break it down into really four main categories. I mean, you could add five in here, but so you've got residential, which is anything related to where somebody lives. But whether that's buying individual single family homes, multifamily, student housing, any of those types of things. Commercial property, so that's going to be like an office building, shopping center, hotels, retail, those sorts of things. Industrial is going to include things like storage, warehouses, logistics, data centers, and then raw land, obviously just barren land. But then you also have these mixed use properties that are, I feel like have become much more vogue recently, where you've got residential that is on top of retail, and you're seeing that a lot more often these days. So different types of real estate that people can invest in. But why do people invest in real estate? And I don't think we have to think way too long and hard about it. The reason that people choose to invest in a lot of different things is they think it's going to be a profitable venture for them. But a lot of the real estate oriented investors that I've met in my life, they don't really like paper assets. They don't like equities. They don't like bonds. They'd rather have something tangible. And so that's what you get as a real estate investor, is you get something tangible. I think a lot of that is probably rooted in the fact that they had a bad experience investing in the stock market or the bond market or something like that. So they want something that they can go and see every day. They could touch it every day if they needed to. Theoretically, real estate is supposed to be not correlated to the rest of your portfolio. As a real estate investor, you're typically looking for total return on properties, particularly if they are developed. So you're looking for some passive income that's going to come off of that, the potential for appreciation over time. You do have the ability to leverage real estate plays, which is a double-edged sword. We're going to talk about that here in just a second. But the big one is depreciation. That's the big thing that you get, is the ability to depreciate tangible property and the ability to be able to expense items that you ordinarily wouldn't be able to. Repairs, maintenance, the taxes associated with carrying the property, all of those types of things you're able to depreciate. And so it can be a good tax efficient way to invest, potentially. Now, there's always the other side of that coin, the recapture of those things, potentially when you sell. We're going to talk about that here in just a little bit. What are the challenges of investing in real estate? Well, it's illiquid. That's one of the big ones. Ironically enough, I've met plenty of these real estate investors in my life who almost view this illiquidity piece as a benefit and not as a challenge. I had one of them tell me, well, Stephen, I've never lost a nickel on my land. And I'm thinking, you're right, Keith. You're completely right about that. But you also were not shown a daily market value for your land. You didn't even get it on a monthly basis or a quarterly basis. The only thing that you really got is something from the local government every year that told you that, surprise, surprise, that property appreciated by a modest amount year over year. and your tax revenues are tied to that. Very curious. But so the fact that you don't see a daily value of where that property would trade for gives some real estate investors peace of mind. They think about it in a completely different manner than they would securities that are traded in the open market. But the reality is, when it comes to actually selling that property, the bid ask spread can be pretty wide. You have in your mind, as the owner of this property, what you think it's worth. You may have something that says what the government believes that it's worth, and they're assessing taxes as of a certain value. But where somebody's actually going to come in and purchase it from you could be a pretty decent ways south of where you're at. And it can take time to actually have the price discovery. It can actually take time. I'll tell you, my personal home that I bought at the very end of 2024 was originally listed in June of that year. And come to find out, when I go to the closing table, they didn't have any offers until we made one. And that's 6 months later. And so you can have a beautiful piece of real estate, but until you find somebody who's actually going to step up and write you a check for it, I hope you're getting good use out of it. Because if it needs to clear, or you get into a situation where you have to sell it quickly, the clearing price, where you're actually going to be able to find somebody write you a check for it, might be significantly lower than the value that you have in your mind. So that is a challenge. Financing costs have obviously gone up a lot in the last 4 years or so. Since 2022, we've seen interest rates rise dramatically because many real estate projects are leveraged. The fact that interest rates have gone up, and folks that even have legacy properties that they bought maybe on an arm of some kind, the carrying cost associated with those properties are rising, and they are rising significantly. And that's going to eat into the profitability associated with a number of these real estate projects. You also have capital expenditures associated with real estate, whether that, if you have an office building or something like that you own, and you have somebody moving in, maybe you have tenant improvements that need to be made. A lot of times, as the landlord, you're probably going to eat a portion of that as goodwill in order to entice your tenant to come into that space. So you've got to lay cash out of pocket to be able to move walls or plumbing or electrical or whatever it is, changing out lights. Speaking of tenants, a good tenant is worth their weight in gold. Bad tenants, oh boy. And it doesn't matter if it's a commercial tenant, if you own a residential property that you're renting. I've had a number of clients who have owned properties, owned homes that they were renting, and you get somebody who's delinquent on paying the rent. That there have been times where they're going to these people who are occupying the home, and they're saying, I know you're not paying me, and we both know that you need to leave, but I will pay you, me as the owner of that property, I will pay you $1,000 if you will vacate the premises and not destroy the house. Most people don't think about that going into it. Repair and maintenance. We've got the picture of the leaking pipe over there. That would be a disaster. Those things happen. And if you are not a handy individual or understand how to address these types of issues urgently when they arise on your own, then the cost associated with having somebody do it is going to eat into whatever profit that you think that you're going to enjoy as a result of owning these properties. And the last is the rising insurance rates. I mean, I think it's almost like a nationwide epidemic at this point that insurance premiums have just been going through the roof pretty much everywhere, to the point where now you have a lot of folks who are contemplating, what if I just carry a very minimal level of insurance on this property for something like liability, but I'm going to take a lot of these other riders off, and if something happens, I'll just eat it because I'm spending an arm and a leg just to maintain insurance on this property. So something that you have to be aware of going into it. Okay. Now we're going to get into the meat of this. One of the main benefits that you have as a real estate investor and that you can leverage, that's part of the US tax code, is the ability to take an existing property that you have and exchange it for a different one without any tax liability. Without any tax liability. So that's right. So this is something that's not available to investors in the stock and bond market, but it is available for investments in real property. So I want to consider the following example. Let's just say you put $500,000 into a stock, and you believe that that stock is undervalued, and over the next 5 years, that stock, it doubles in value, and now it's worth $1 million. And you could sell that stock because maybe you feel like, okay, it's gone up a lot. I think it's getting overvalued. I would rather go and buy another one of these undervalued assets out there. So you sell that stock. You've got a $500,000 long-term capital gain. And so merely booking that transaction for that year is likely going to move you into the top federal tax bracket, which is going to mean that your long-term capital gain rate is 23.8%. So you're going to owe $119,000 in taxes to Uncle Sam as a result of doing that. That's 23.8% of a $500,000 gain. So that's going to leave you with $881,000 left that you can invest in whatever this new stock is that you want to buy. That's not too shabby. But if this was a real estate transaction and you said, look, I had bought this undervalued property, it had appreciated, it has done as well as I thought it would. Now I'm looking for the next undervalued asset. You could take that $1 million and you could exchange that one property that's worth $1 million into another property or properties that were worth $1 million and not have any tax liability. You're going to be able to shelter all of that gain. And you're doing it using the privilege of Section 1031 of the Internal Revenue Code. So this is when you have to exchange it for like property. Now, that doesn't mean that it has to be, if it's residential, that you have to make it another residential property. The definitions there are pretty broad. The one thing that it cannot be, you can't have property that you own in the United States and say, I'm exchanging it for a property in Mexico. It can't go international. That is not like kind. You can change the geography within the United States. You could go from I own residential properties to I own office building. Those types of things will pass muster. Okay, but it has to be a like property. Pretty much anybody can use it. You can do it as an individual. If you own properties in trusts, partnerships, corporations, this is available. This is something that you can use. But there's two main things that you have to do in order to make this happen. The first one is the use of a qualified intermediary. A qualified intermediary is going to be the group that is going to custody the money for you when you sell that first property. Because here's the kicker. If you're going to perform a 1031 exchange and be able to defer out all of the tax liability associated with the gain that you have, you cannot have constructive receipt of those proceeds when you close. So when you go to the attorney's office and you're signing, you're not getting a check for that money. You're not walking away with it. It's not going into your account. That money is going to go and sit with a qualified intermediary who's going to hold the money for you. And then you have 180 days to be able to close on a new property or properties. Now, that 180 days is bifurcated because you have 45 days to identify a new property that you're going to buy. And then you have 135 to be able to close after that. So a total of 180 days after you sell to be able to close on the subsequent property that you're going to buy. So it looks like this. So you're first going to need to identify what qualified intermediary are you going to work with. You can Google qualified intermediaries in my area, or if you own properties in specific regions of the country, you can try to find somebody who works in that area. There are also some national qualified intermediaries that you could work with, but you're going to make sure that you find that group first and let them know, I'm interested in pursuing a 1031 exchange, and I want you to custody this money for me as we would close. So you have to do that first. Then you list the property that you're trying to sell, right? Now, when you sell that property, notice that the proceeds there, they're going to the qualified intermediary. They're not coming to you. They're not going to you. You're not going to have constructive receipt of that money. That is what's going to allow you to avoid paying the taxes associated with that transaction. Qualified intermediary is going to hold the money. You've got 45 days to be able to identify the new property. And then you've got up to day 180 to be able to close on those new properties. And when you go to the closing table for that replacement property, the qualified intermediary is going to send the money that they have been custodying for you to the closing attorney's office. And that's how you're going to buy your new property. So that's the way that the 1031 exchange cycle works. Now, what if you don't want to be a landlord anymore? This is what we're seeing a lot more frequently these days, is the use of 1031 exchange funds. Because there are plenty of investors out there who have done well over 30, 40 years being a real estate investor, but they're tired of being the landlord. They're tired of getting a phone call for a leaky faucet or a leaking pipe or whatever it is. They're tired of dealing with the tenants. But they also know I've got a substantial amount of appreciation in these properties over time. Perhaps I've depreciated these properties. Remember we talked about depreciation earlier? That's a way that you're going to be able to lessen the tax liability that you would have just by virtue of owning that property. But whenever you would sell a property, if you didn't do a 1031 exchange, not only would you have capital gains tax that you would owe on the appreciation above your basis, but if you had depreciated that property, if you had written items off against it, you have what they call income recapture. So if I went back to that example of you bought a $500,000 property and it appreciated to $1 million, but you had taken $100,000 worth of depreciation against that property. If you simply were to sell it, you'd have a $500,000 capital gain taxed at capital gains rates, long-term capital gains rates. But that depreciation that you had taken, you have to pay ordinary income tax on that. So you have recapture of that 100,000 that you had written off against your income for all of those years. And so selling that property, the tax liability can be somewhat onerous. So you have people who have invested in this space over a long period of time to say, I'm tired of the headaches, the challenges associated with owning tangible real estate. And I don't want to forfeit the tax benefits that I have there, the deferred gain, the depreciation that I've taken. So the solution for them are these 1031 exchange funds. So the DST, or the Delaware Statutory Trust, is the beginning of these 1031 exchange funds. It meets the like-kind replacement definition per the IRS. So you can take the physical properties that you have and you're going to sell them. Again, you're still going to need this qualified intermediary. You're going to sell those properties. The qualified intermediary is going to get the funds, and then you're going to redirect the funds into these 1031 exchange funds where you will receive units. You're going to get shares, almost like it's a stock, but you're going to own an interest in tangible real estate. So this is a really good solution for older investors who have done really well in real estate. They want to maintain all of the tax shelter that they have built up over time in the physical properties that they own. But now they're really looking at an easier way to transfer these assets to their children, to their beneficiaries. Because what they're going to be able to do is, if they have multiple children and they could own multiple different properties, that what they don't want is the kids are going to end up fighting with each other and saying, oh, well, I want to keep this property, or I want to keep this property, or somebody just wants out. They just want their cash. Then instead of making them bicker with each other, you're going to say, look, we're going to be able to give you the value of whatever those real estate holdings are. You're going to diversify, because instead of just owning a handful of individual tangible properties, you're going to be geographically diversified. You're going to own different types of real estate inside of that same 1031 exchange fund. So not just residential or commercial, you're going to own all of them. So you're going to be diversified. Also geographically, most people who've invested in real estate that I've met, they're typically invested in one area, one city, one town, one state. This is going to allow them to expand the footprint that they have. So if there's any sort of natural disaster that happens, it's going to help them mitigate that risk. But at the end of the day, they're going to end up with units in this 1031 exchange fund. And then when they pass away, those units will pass to their beneficiaries. They will get a step up in basis, just as they would have if they would have owned those physical properties. But now the beneficiaries, they're going to be able to make the decision based on their own desires of what to do with that asset. Do I keep it? Do I sell it? If I want to dispose of my shares, I can do it pretty simply. If I want to keep my shares, I can do that. But now I don't have to go and argue with my brothers and sisters and whomever else it is about what my desires are for this, because we've already tried to solve that. So this is actually a great estate planning tool for people who have been invested in the real estate space. You're able to maintain the tax shelter. You're still going to get a nice regular distribution that comes off of that 1031 exchange fund. You're not going to have to worry about the problems associated with being a landlord anymore. That's not your problem anymore. And then it's going to allow you to pass those interests along to your children in a much easier manner. So the 1031 exchange fund really serves a great purpose for people who've been invested in the space for a long time. They don't want to simply sell, have a tremendous amount of income recapture, and pay all these taxes. So this is a great solution for those individuals. Okay, that is it. That is all for our review today. If you have questions about this, feel free to send us an email. You can reach us at info@reveillewealth.com. If you want a copy of these slides, also send us an email. We've got a PDF copy that we can send along to you. But I hope that this has been helpful for you. If you're an advisor out there and you have clients that have been invested in the real estate space, those 1031 exchange funds really can be a great solution for those individuals if they're experiencing some of those same challenges. So thanks everybody for tuning in. Send us your emails. Again, like I said, if you have questions, we've gotten some really great feedback from a number of you watching out there. We appreciate you tuning in. And our objective is to just share with you what we're doing for our clients on a regular basis and what we've learned in our experience. So hope that it is beneficial for you and helping you serve the clients that you have. And if you're an investor, giving you some great ideas to consider. But thank you for joining us for this installment of the $1 Million Question. Have a great weekend. See you then.